3, 2, 1. There you go.
Okay, welcome to today's Lunch with Don, where you bring your questions and your own lunch. Sorry, we don't do that. And we answer questions that have come in. And so if you've got questions that you want to throw at us, go ahead. I'm going to respond to a couple questions that have come in by email. And then, but you're the priority, and so your questions trump anything that came in by email. How do we fund a business? Do we do a loan to it? If we're setting up a business, that's one of our most frequently asked questions about how to set up a business. I want to put a piece of property into a business, or I want to set up a corporation, but I need some seed capital. Most of the time, there's two ways to fund a new business. We're talking LLCs, corporations, limited partnerships. There's two ways to do it. We could do a promissory note, or we could consider this to be your capital contribution, and that's all we do. We put it, we list it as a capital contribution on the books. If we do a promissory note, there comes with some stipulations. There are 7 guidelines that the IRS looks at, and the courts also follow this to determine if this is a legitimate loan from your either a personal loan or from business to business. And so most of the time, I really don't like promissory notes, but those 7 things would include: is it written? Do you have a promissory note that's written? Is there a promise to pay? Is there interest? Are there penalties attached if you don't? Is there a payment schedule? Is there collateral offered? Do both companies have the ability to pay or to receive funds? And then, is there follow through? Did you actually follow through with the agreement? That promissory note, you wouldn't sign a promissory note to a third party and then not pay them. But yeah, this is a legitimate loan. We wouldn't do that, and you'll find that a lot of business loans that we're giving a loan to a business to get started are really, they don't meet those 7 guidelines. Therefore, if you're not going to play the game, don't play the game. So most of the time, what you contribute, let's say I'm going to start up a corporation and it needs $25,000 in seed capital. We could put in the 25 or a little 30 so that there's a little slush fund. We put that in, and that would be listed as a capital contribution on the books. Consider looking at a balance sheet, and if you're familiar with a balance sheet, what it does is it lists all the assets of the corporation, the short-term, the long-term assets of the business, and then it lists on the other side, it lists here's all the debts, here's all the liabilities, and there's a little section for owner's capital. Here's what the owners put in. Now both sides have to equal, they have to match, the bottom line. If this is $120,000, this has to be $120,000. And so what they're saying is the owners really, what they contributed is not really a debt, but it's sort of a debt, because they could at any one time they could come in and pull all that money back out, leaving the corporation. So it's considered kind of a debt. I'm not a full-fledged CPA accountant, but that's how it looks. So at any one time, if you wanted to pull some money back out of the corporation, then all we would do is list that as a return of capital. And that's not a taxable event to move money in and out of your business if you're the sole owner. Now, if there's other partners, that might cause some tax problems. But if this is your business, it's my C Corp or my S Corp, I contributed capital, and then I do a capital return. I reverse that. That wouldn't be a taxable event to either one. All right, another question that we get often, and I'm glad they asked this, is if you and your attorneys set up my limited partnerships, my LLCs? Will you also defend it in court if I ever get sued? And the answer is you wouldn't want an attorney that drafted a trust or drafted a limited partnership to defend you in court. Every attorney has different specialties. And some of them are just mad dog. They are fighting attorneys, and they are really good in court. And they know how to play the games. And they know how to slow down a process or speed up a process, or they're good at depositions. They're good at interrogatories and requests for admissions, and they understand the game. Other attorneys have a specialty in real estate, or maybe they'll have a specialty in creating estate planning documents. So the answer is if you hired, let's say, Anderson Business Advisors, or Solberg Law, or other attorneys that we've referred people to over the years, do you expect them to fight in court if you ever get in trouble? And the answer is no, that's not what they do. Nor would you want them to, because that's not their specialty. But they could act as a consultant to your attorney. In fact, that would be a really good idea, is to bring them in of counsel to your litigating attorney. So I hope that makes sense. It's not that they can't. That's not their specialty, and that's not what you want. Our attorneys. The attorneys that we're using are looking over every limited partnership, every LLC, every corporation that's being broken. They're drafting documents that make them very strong. They're looking at the courts. They're looking at the appellates. They're looking at, and they're really good at drafting documents. That doesn't necessarily make them really good in court. Okay, do employees ever get sued? Oh my gosh, the answer is yes. Let's say you're a W-2 employee. You're working for, it doesn't matter who. Do employees get sued? And most of the time, I like the question, because you're going to work and you're thinking about the scope of liability that I have. For the most part, your employer is going to take on the responsibility as long as you're acting within the scope of your employment. You're following your employee handbook. You're doing what they do. Their liability insurance should cover you. It's when you go outside of that scope of employment. It's when either criminal or negligence, maybe there's a harassment suit in the office, failure, neglectful. I wasn't following what the guidelines. But yes, employees get sued all the time. The very first lawsuit that I had was I was an employee of a recreation park, and there was a drive-by shooting. I got named in the lawsuit because I was the manager on duty when the drive-by shooting occurred, and I should have ran out in front of the bullet. Now, did the company defend us? Yes, they did. But they also advised us, if we wanted to go get outside counsel to make sure that our interests were protected, because the attorneys that were hired by the insurance company and the company's insurance or the company's attorneys were looking out for the company's best interest or the insurance company's best interest. They weren't necessarily looking out for mine, and they strongly suggested that we have our own personal attorneys as well. All right. Has a limited partnership that we've created or an LLC that we've helped draft? Now remember, we sell legal forms. Or if we refer you to an attorney and they set this up, have these LLCs ever been broken? Has a Wyoming corporation or a Nevada LLC ever been broken? And the answer is yes. They're broken all the time. But you have to understand why they're broken. They're broken generally most of the time because of lack of formality, something that you did that didn't keep up the corporate documents. Whenever there's maybe you commingled funds, maybe you didn't pay your filing fees on time, maybe you disregarded the taxes, and you haven't paid your taxes for a little while. When LLCs are broken, most of the time, it's because of lack of formalities. Every entity, no matter whether it's a single member, multi-member, whether it's a corporation, an S corp, a C corp, a limited partnership, doesn't matter. They all have requirements for maintenance, and if you don't maintain your entity properly, it can be broken. Now there's times when you're doing everything right, and the judge simply sets this aside and says, you know what, there's other factors going on. Maybe there was fraudulent conveyance. Maybe the state laws don't protect in your state a single member LLC, and they're looking for stronger statutes. And so yes, oftentimes limited partnerships have been broken, but then on appeal, the appellate judge, the appellate court comes back and overturns that and goes, no, this is a legitimate LLC. But you've got to fight for that. So do legal entities work? Yes, they do. Have they ever been broken? Yes, but look to yourself 95% of the time if there's a reason that's why it's going to be broken. That covers most of it. If I'm setting up 5 LLCs, do I need 5 individual EIN numbers? Remember, the EIN number is an employee identification number. Whether you have employees or not, that's what the federal government calls it. It's kind of a mislabeled name, but that's what we call it. So regardless, it's like a social security number for your business. And if I'm setting up 5 legal entities, what I'm trying to say is this one entity stands all by itself. It is an independent. If anything happens here, we're not going to topple like dominoes my whole estate and take all 5 of them out. So the answer is yes, you're trying to say this is a separate legal entity. It has its own bank account. It files its own tax return, or maybe it's disregarded to somebody else, but we're recognizing this. It's got its own separate books. We don't commingle funds with anything else. And yes, every LLC that you create, every limited partnership, every corporation, everyone has its own individual EIN number. The example I've used for years is, let's say we have twins or triplets. Well, they were born on the same day. Would the IRS give them all the same Social Security number? And the answer is, heavens no, because you just gave birth to a taxable entity. Whatever that is. You created your own little baby LLC, and the IRS is going to want to treat this separately. And more importantly, you're going to want to keep it separate and keep the liability of anything that happens in here from bleeding out anywhere else. Okay, Kendall, are we getting any questions from any of our students yet?
Yeah, so Marie asks, I have a question about paying one's children from a sole proprietorship.
Okay.
Does one need to have a payroll company to do that, or can the funds be paid directly from the sole proprietor's DBA account? So like to a kid's Roth IRA.
Okay. So really good. And no, you don't need a payroll company to do this. But you're generally treating them either as an employee or you're treating them as independent contractors. And it's fairly easy with a sole proprietorship business, or let's say it's an LLC taxed as a sole proprietorship or a disregarded entity. You can simply pay them as 1099 children. And yes, you exercise control over them, but I think I've done that with most of my kids. I've treated them as a 1099. Now, what we do when we do that is anytime we're paying them over $600 or $600 or more per year, We still have to give them a 1099. That does not mean that they have to pay taxes on it. But I've never run my kids through a payroll company and taken. I always do the 1099 at the end of the year, and anytime we've paid them over, $600 or more, I've always treated them and give them a 1099. The reason I like your question, Marie, is that when we're paying kids out of a sole proprietorship business, like apparently you are, it also, there's a limit on what they would have to pay self-employment taxes. But where you're paying them out of a sole proprietorship business, that requirement is waived. So not only can they make up to $12,600 without paying federal income tax, you also have waived the requirement that they pay self-employment taxes on it. So that 15.3% self-employment tax. So good question. Did I answer it, I think?
Is there a difference between paying or benefit between paying and versus gifting?
Yeah, a gift. If we're paying our kids out of the business, let's say that the business makes $100,000 this year, and I'm paying for employees and I'm paying for independent contractors. What that does is that reduces the tax that's due in my business because it's a legitimate business expense. If I simply gift it out of the business, I'm going to pay the taxes on it, and then I'm going to gift. So one is pre-tax, one is after-tax, and we. If you're gonna pay your kids, do it in a way that's tax deductible to you, most of the time. And if not, if we're going to do a gift, just know that you're going to pay the taxes and then gift it away, as opposed to paying them as a salary.
Great.
Hopefully that makes sense.
Yeah. Anthony asked, how do you get around UBIT, right? UBIT tax without setting up a corporation blocker? Are there other ways out there to do that?
Okay, so a UBIT tax is when your IRA is earning money. Let me explain a little bit more. Let's say you've got a piece of real estate inside of your IRA, and it's got a loan against it. So I'm using outside credit. I'm using a bank. I'm using a credit union. There's leverage inside. What that means is that at the end of this, when I go to sell the property, I have the potential of paying UBIT taxes. Now, if I've paid off the debt at least a year before I sell the property, then I can avoid that. And having a corporation blocker is one way, but another way to avoid the UBIT tax is to simply pay off the debt a year before you've sold the property. And so if you've got a property inside of your IRA and you're using leverage, and maybe you're getting enough money and putting, you're not taking the money out of your IRA most of the time, so that stays in there anytime, and then continual contributions, if you can use that to pay off the debt, that's the most ninja strategy I know to avoid the UBIT taxes. Okay?
Shelley Hughes. Well, Shelley Hughes -Spradling now. I didn't know that. But
oh, good.
Shelley Hughes says, thank you so much for the info.
Shelley is one of our, we used to work together and love working with you. And glad to know. Oh, I did see on Facebook that Shelley had been married. So congratulations on that, and thank you.
Awesome. We got another one coming in.
All right, so go ahead.
Marie, so if they're paid less than $600 per year, a 1099 is not required. For greater than $600, how do I issue a 1099 if disregarded entity exists as a DBA bank account?
All right, so most commonly, when you go to fill out your taxes, they're going to ask you, was your business required to do 1099s? You simply do a 1099. There's a requirement that that you do a 1099. They're all issued before January 31st. And then you as a business are required to do a 1095 saying, here's all the 1099s that I issued. And this is a form that you'd fill out. Your accountant can fill that out, or you can fill it out. I do it for most of our businesses. And I don't know, if you're using QuickBooks, there's a little calculator in there. They'll do it for you. Your business, even though it's a sole proprietorship, it probably has its own EIN number. You probably needed that to get a bank account, either that or is your Social Security number. Most of the time, people will get its own EIN number, but a sole proprietorship can issue 1099s. We do it all the time. It's a very, very common thing. So your accountants, your accounting software, anybody can help you with that. Or call customer service. We'll help you walk through it. Yeah.
It's pretty easy. Yeah.
It's a 1099.
Pretty
Yeah,
simple, yeah.
It's simple. Okay.
That's it. That's it for questions so far.
Okay. Got another question here that came in, and tell us about pure trusts. And pure trust falls into a category of tax evasion strategies that we know about, we teach about, but we encourage people not to use them. It's also called a constitutional trust, and there's people in the U.S. that believe that the 13th Amendment, allowing the federal government to tax us as individuals, was never fully ratified. Therefore, we do not have an obligation to pay our federal income taxes. And whether that's true or not,
good luck with that.
I'm not going there.
That's not worth the risk.
It's just not. The courts have decided that you do have an obligation, and the courts have ruled that the IRS does have the right to collect. And you may be absolutely right, but the price you're going to pay, and your family is going to pay if you serve, a 3, 4, 5 year jail sentence to prove that you were right, may not be worth the cost that it goes through. There's always new promoters out there of constitutional trusts or pure trusts, and now there's a new one that's out there that's an irrevocable irrevocable trust that avoids paying all taxes. We don't go there. There's what's called a corporation sole. If you claim to be a pastor or a religious leader, the problems with that's a legitimate thing for pastors that the IRS, the Congress allows. But too many people go, well, I've got a ministerial certificate. If not, I can get one online, and therefore all my business is tax exempt. I'm going to buy real estate. I'm going to buy stocks, and everything that I'm going to do is for the, well, okay, do you have a flock? Do you have people do you have ongoing services? There are requirements for these. A corporation sole is a legitimate IRS recognized entity. But it's not but there are requirements, and if you don't follow the requirements, then you don't get the tax perks. Not just anybody can be a minister without a congregation and expect all the tax perks from it. So pure trust, constitutional trust, corporation soles, we take with a very, very big salt lick, 50-pound size grain of salt. And most of the time when we're seeing somebody promoting it, you watch. And 3 or 4 or 5 years down the road, they'll be in jail for promoting it, and you're going to be audited. We don't want to put our students in that position. So we stay very clearly away from that. Right or wrong, you may be absolutely right, but it's not something we as a company are going to promote. And so we like to stay in the black area of the law and not go to...
Same with being guinea pigs on the new, latest, greatest thing. You want to be a guinea pig, Good luck with that.
Yeah.
We don't. You can do it domestically here, United States, most of the time, just fine.
Yeah, offshore trust is another one where there's a legitimate way to do offshore trusts, and we believe in them. They're legitimate. There are ways to reduce capital gains taxes, to avoid some taxes, but the complexity of it and the tax forms, if everything is straight up, but don't do it at purely, in fact, don't do anything as a pure tax avoidance strategy. Always tie everything you do into your business dealings. There has to be a business purpose for it, maybe an estate planning purpose, maybe I'm gifting to lower tax brackets. There's a lot of reasons why we do things, and the more multiple reasons you have. But anytime we're doing something strictly for asset protection or strictly for taxes, most often that could be unwound. And so that's a general rule. I'm generalizing, but you get the idea, I think. All right. Any other questions?
No, it's great. They said you're really funny over Amendment 13.
Well, I hope that even though I made light of it, I hope you understand the seriousness of it. We don't teach tax evasion strategies. So with that, we're going to end 2 minutes early. I hope you don't feel ripped off for being here. Thank you for being on. And bring your questions. We'll be here next week. And until then, make it a great day.